What's going on, guys, and welcome back to another video. Now, I know that I said that I would release a video on PayPal today, but I changed my mind. And the reason for that is because Microsoft just released their earnings, and I figured that considering that they've been on quite a dip recently, that a lot of people are probably watching this one quite closely and are interested in how those results went, how those earnings went. So I figured that we use today's video to run through that and also give my updated position on my fair value of the stock. So without further ado, let's get into the video. So I think one of the first things to point out is the fact that year to date, Microsoft is down 14%. Now we're only 25 days into 2022. And I read somewhere that Microsoft is on course to have its worst performing month in terms of the stock since 2010. So clearly this is not something that we're used to seeing from a stock like Microsoft. One might argue though that this pullback was expected, particularly given the fact that at one point in the year it was up as much as 47%, and it's still up over 25% despite the recent drop. Now, given the fact that the stock actually fell as much as 7% in the after hours before the release of the full year guidance, you might be forgiven for thinking that the quarter that they've just had wasn't a good one. But actually we can see here that Microsoft beat on their revenue and their earnings, and then they later delivered an upbeat forecast for the fiscal third quarter. So we can see here that the company delivered $2.48 per share of adjusted earnings versus $2.31 per share, which was expected by analysts. Similarly, revenue was $51.7 billion compared to $50.9 billion, which were expected by analysts. So in terms of growth rates, revenue increased by 20% from the year prior and earnings grew by 21%. So solid growth. In fact, that their net income is growing at a faster rate, albeit ever so slightly, then their revenue is a good sign as well. That shows margin expansion. So all of that sounds very good. So why did the stock initially drop in the after hours? Well, the reason for that is because the revenue from Azure and other cloud services grew 46%, ending a streak of 4 quarters at or above the 50% mark. Now, when you dive into the income statement, that's when you really start to realize how solid this business really is. So we can see here that we've got total revenues of $51.7 billion, and that is compared with $43 billion a year earlier. And bearing in mind, we're not talking about full year revenues here, we're talking about revenues achieved in only 3 months of results. Now, when you dive into the composition of those revenues, you can see that product revenues account for $21 billion and service and other revenues account for $31 billion. Now, when you look at this compared to a year earlier, product revenues haven't really moved all that much, but their service and other revenues have gone up by around $7.5 billion. So it's clear to see that the driver of growth in this business is their service and other revenues. Now, the best thing about that is that their service and other revenues are a higher margin service and a higher margin business, and that's why we're seeing their margins improve over time. And I think that this is why so many people are bullish on Microsoft for the long term. And then when you come down to the cost of revenue, we can see that product costs are at $6.3 billion and service and other costs are at $10.6 billion, bringing us to a total cost of revenue of $16.7 billion and a total gross margin of $35 billion. So they make $35 billion of gross profit on that $52 billion of revenue. Clearly, this is a very high gross margin business. We're talking about a gross margins of something like 70% for this business. Then you come down to their operating expenses, and we can see that research and development costs have increased by somewhere between 15 and 20%. Now that's pretty good, and you always want to see a company putting money into research and development to come up with new products to drive revenue growth. That's always a good thing to see. Sales and marketing expenses have actually remained, right, they've only gone up by, looking at their around between 9 and 10%, which is very good considering the fact that their sales have increased by 20%. So they're putting 10% of expenses or additional expenses into sales and marketing, and that is driving their revenue growth by 20%. So again, that's very good to see. And then we come down to general and admin costs, and actually for this type of business, they don't spend all that much on their admin costs, so they actually run the business really well. We can see that that's at $1.4 billion on $52 billion of revenue, so clearly that's very good. And they've also only increased by about 15%. Now that's good to see because it shows that their revenues are increasing faster than their admin costs. So again, you get that operational efficiency and that margin expansion, albeit only by a small amount, but any amount at this sort of size of business, considering that their net margins are already at something like 37%, is always very impressive to see. You come down to the balance sheet, and once again you're reminded just how big this business is. We're talking about a company that has cash and cash equivalents of $20.5 billion and then short-term investments of $105 billion. We're looking at total cash and cash equivalents of $125 billion. I think then it makes sense to pivot on for a moment onto their acquisition of Activision Blizzard, which is going to be for, I believe, $67 billion, which is going to be the largest acquisition that they've ever made. Now, considering the fact that they are actually holding $125 billion in effectively cash, if they wanted to, they could acquire Activision Blizzard with the cash that they're holding. Whether they decide to do that remains to be seen, we don't know yet. But considering how strong of a financial position they are, it's nice to see that they're not stretching themselves with that acquisition. Now, do I think that they'll spend the full $67 billion of cash on this acquisition? No, actually I don't. I think they'll use a mix of some cash that they already have, and I think that they'll also take on some additional debt. Despite the fact that interest rates are increasing, debt is still incredibly cheap, and I think it will make sense for them to use a mix of cash and debt in order to fund this acquisition. It's also worth pointing out that this acquisition is actually going to be going through at $95 if everything is confirmed by regulators and so on. And as a result of that, you've got this sort of arbitrage, right, between the fact that you can buy Activision Blizzard now for $79, you can wait between 6 months and a year, wait for the acquisition to go through. I think it's more likely going to be a year, and then you can collect that extra $15 per share. Now, the reason why that arbitrage exists is due to the risk. So there's a chance that the acquisition won't go through, and if it doesn't, then there's a high probability that you're going to see that Activision stock fall back down to around $60. So there is a risk associated with it, but if you're willing to take on that risk, you could see a decent return within a short amount of time. Now, despite all of that cash that they're holding, $125 billion, they do have some debt, and this is what I was talking about with the fact that just because you have cash, it doesn't necessarily mean that or make sense for you to pay off your debt, especially if your debt is really cheap. So we're looking here and we've got current debt of $5 billion, and then we come down here, they've got long-term debt of $48 billion, and then they've also got some operating lease liabilities as well, which I personally consider as debt. Despite that debt, clearly they've got more than enough cash to pay off all of that debt if they wanted to, so there's absolutely no problems from a financial health perspective from this business, which I don't think anybody is going to be surprised about. Now, in terms of the free cash flow of the business, we all know that Microsoft is a free cash flow generating beast. We've got net income here of $19 billion, which is what we saw earlier in the income statement, and then you make the necessary non-cash adjustments, and you arrive at cash from operations of $14.5 billion. If you then wanted to arrive at free cash flow or non-GAAP free cash flow, then we can subtract the capital expenditures, and you arrive at free cash flow of just below $9 billion for the quarter. Now, in my personal valuations, I use unlevered free cash flow when I'm using my discounted cash flow model, rather than free cash flow from operations less capex. And there are some nuances in the differences there, but generally speaking, you should be using unlevered free cash flow. However, if you don't want to have to work out unlevered free cash flow from operations less capex is a more simple way of calculating the free cash flow, and generally speaking, there shouldn't be huge amounts of differences. There will always be differences, but it shouldn't be massively significant. Now, in terms of what else they're doing with all that cash that they're generating, we can see here that they've repurchased $7.5 billion worth of stock, which is very good to see. That's them rewarding their shareholders. And then they're also paying dividends. So not only do they do share buybacks, they also pay dividends, and that's how they're distributing their cash that they're generating to their shareholders. And then that brings me into my valuation model for the business. Now, I've run through all of this before, so I'm not going to go through it all again, but I'll go through some of the general inputs. So we can see here for 2022, we're expecting revenues of, and bearing in mind this is a half year result actually, because their year end is in the middle of the year. So we're looking at revenues of $197 billion. And then following that, we're looking at revenues of $224 billion. That's growth rates of 17% and 14% respectively. Now, both of these have been taken from analyst estimates. Thereafter, I've gone with a growth rate, revenue growth rate of 14%, and I've gone with a 6 to 10 year revenue growth rate of 10%. Now, if we look at the historical growth rate, 14% looks to be fair for this type of business, given the size of the business. Yes, they have had 2 years of very strong performance. So in 2021, they've had 17.5%. In 2022, we're expecting 17%. So they have increased that growth rate, but we do believe, and analysts do believe, that that is going to then fall back again. Effectively, they pulled forward, some of that growth. And as a result of that, that growth is then going to decline. Now, once again, I'm not going to run through all of this line by line, but we can see for 2021, they achieved net income margins of 36.5%. And that was a significant increase compared with 31% for the year prior. But you can see that the reason for that, a lot of that was actually driven by this extraordinary income or unusual income in effect, or non-recurring income. My model has them achieving net income margins of 36% for 2022, and management have given us a good indication that that's around about where they're going to fall, and then that's going to rise, according to my model, to 38.5% by 2026. We've got a weighted average cost of capital of just 8.2%. The reason for that is because their cost of debt is really, really low, and the reason for that is because they're such a financially sound business. So we're looking at a cost of debt of only 2.8% for this business. We've got a low beta of just 0.92, which means that this stock is about 92% as volatile as the stock market. So actually the stock market itself is more volatile than this stock. Over the last 5 years it has been anyway. And then we're looking at a weighted average cost of capital of 8.2%. So that means that at the end of my 10-year forecast period, we're looking at revenues of $534 billion compared with $168 billion at the end of 2021. Now, the best thing about this is the fact that on that $534 billion, they actually get to keep, in terms of net income, $206 billion, which represents a 38.6% net income margin. Now, there aren't many businesses that will exist generating revenues of $534 billion. There certainly won't be many businesses that generate that much revenue at such a high margin. So if you think about a business today that generates this kind of revenue, we're talking about your Walmarts and you're talking about your Amazons, and that is pretty much it. And neither of those businesses have anything close to a 38.6% net income margin. So this is seriously impressive. So then in terms of unlevered free cash flow, we can see that actually unlevered free cash flow as a percentage of EBITDA has been declining over time. So it was 79%. For the most recent year, it was actually 61%. Now the reason for that is actually primarily because of capex, right? They've been investing a significant amount of money in capital expenditures in order to grow the business. I'm actually predicting that their unlevered free cash flow as a percentage of EBITDA will go from 65% in 2022 and gradually rise to 70%. So where does that leave us from a fair value perspective? Well, we're looking at an intrinsic value per share of $285 according to the discounted cash flow. And actually, if you're looking at a multiple of earnings using a P ratio of 20 in 10 years time, you're looking at an intrinsic value per share of $262, or price per share in 10 years time of $578. Now, in terms of the rationale for a P ratio of 20, well, despite the fact that this is a very, very high net income margin business, in 10 years time, I'm expecting this business to have just not finished growing, but effectively have been growing for 10% per year in terms of revenues over the last 5 years. As a result of that, it's a relatively slow growing business, very, very mature, and as a result of that, it's going to get a slightly lower PE multiple. That leaves us with a fair value per share of $273, which to me suggests that actually there's no margin of safety at the current price. It's about 5% overvalued at the current price. Now, given the fact that it is only slightly overvalued, that doesn't mean that you're not going to see any return at all on your investment. It just means that the chances are that your return is going to be lower than the discount rate that we applied earlier on, the weighted average cost of capital. And that's more or less what we see here, right? So I've applied an enterprise value to EBITDA multiple of 18, which is quite a lot lower than what the current price is, or the current multiple is. I think currently it sits at around 22 or 23. So then naturally the question becomes, what is my rationale for using an enterprise value to EBITDA multiple of 18, given the fact that actually it's currently trading at a multiple of 24.5. And now the reason for that is because I think most people are aware that following COVID, right, and the increased liquidity in the markets, multiples and valuations have gotten very, very hot. And if actually we take this back, right, and we go to effectively prior to COVID, we can see that the average was 18.5, which is more reasonable for the type of business that this is. This isn't a hyper growth business. It's a very solid business that is growing at a reasonable rate and also has very high net margins. So yes, it does demand a high multiple, but maybe not one that is, what it is reflected now, which is 25. And actually, maybe a month ago, that was sitting at something like 27. So I think that the pullback is necessary. If we actually go even further back, right, if we look over the last 13 years, their median enterprise value to EBITDA multiple was actually 12.3. It's been as low as 5, which is ridiculous, and as high as 28. So, a median multiple of 12. I don't think that that is fair, because since then they've increased their net margins by greater amounts than what people were expecting, and also they've actually grown at a fair bit more than what people were expecting as well. So I think 18 is probably reasonable. When you incorporate the fact that they tend to buy back around 0.5% of their total shares outstanding every year, and the fact that they pay a dividend of about 0.9%, we're looking at a total return of around 8.7%, which actually isn't bad. But this business for me starts to get really interesting if it fell to somewhere like $250, or even, ideally something like $230. Will we see those valuations? I don't know, but it would be nice if we did. Anyway, guys, I hope you've enjoyed the video, and until next time, thank you.